Welcome, everyone, to the Information's TITV. My name is Akash Pasricha. It is Tuesday, June 16th. New this morning, SpaceX has finalized its $60 billion deal to acquire Cursor. It is expected to close next quarter. SpaceX shares, of course, continue to surge. They are up more than 60% from their original IPO price. The company is now valued at more than $2.5 trillion as of this morning. First up on today's show, the Information's Asia Bureau published exclusive reporting that DeepSeek has closed its first funding round. We'll bring on our Asia Bureau chief to share with us how big the funding round was, how much the company was valued at, and why it was an uncommon deal structure. We also have an exclusive story that Polymarket and Kalshi are taking steps to battle fraud on their platforms. We'll then dive into new reporting on Broadcom's bold move to boost demand for its AI chips and Nvidia's rising share of the AI inference chip market. And we'll wrap the show with some analysis on Fox's $22 billion acquisition of Roku. It's going to be a fun show, so let's get right on into it. DeepSeek has closed a big funding round, although the deal structure is slightly uncommon. Joining me now to discuss that is Jing Yang, our Asia Bureau chief. Jing, welcome to the show. It's great to have you here.
Thank you for having me back, Akash. Although I would have to say that it's more than slightly unusual. In my 7 years covering VC deals, I've never seen a structure like this.
Okay, well, so let's get the brass tacks here. So how much did they raise? What are they valued at? And let's get to the deal structure.
Yeah, so they raised more than $7.4 billion equivalent. So the funding round was mostly denominated in yuan, RMB. So in that term, they raised 50 billion yuan. And I would categorize the investors lineup into three types. Four types. First is the DeepSeek CEO Liang himself, who wrote the biggest check, 20 billion RMB. And then we have the second lineup, which is basically the who's who of China's tech giants. You have Tencent, JD.com, NetEase, and also EV battery giant CATL, all writing checks of different sizes. Then we have the third usual suspects of some of China's top VC firms, and then the fourth type is China's national AI fund.
Okay, and let's go to the deal structure. I now you've piqued my curiosity. Why is the deal structure so crazy?
Yeah, and I want to set this up by the different categories of the investors, because basically we can put Liang himself as the CEO and a controlling shareholder in one pocket. We don't care how he wants to use his money, right? And then for the remaining three categories, with the exception of China's National AI Fund, which is step-backed money, the two others have to actually wire their capital into a limited partnership structure managed by DeepSeek's CEO Liang Wenfeng, instead of putting that capital into the company directly. That's unusual feature number one. And then number two, as a part of that limited structure arrangement, these investors have to subject a lockup period for 5 years. Basically, during the 5 years, with I think the only exception if the company goes public within that 5-year period, then these investors cannot sell their shares to anyone else. This is unusual because you've seen in big VC deals like OpenAI, Anthropic, etc. in the US, or buy downs and others in China. Usually, when you have a very big company that is raising billions and billions of dollars, what happens after the rounds are closed is that these shares get changed hands pretty actively on the secondary share sale market, because some investors might want to exit before the IPO happens, and then they have the avenue to do that. But then this would also mean that probably your shares will end up in investors that you may not even be able to fully trace, like who ends up really holding your shares. So DeepSeek wants to eliminate that. The CEO wants to eliminate that. So to that end, he's the structure they come up with is this 5-year lockup. And then second, unusual part would be, since you are actually investing in this limited partnership managed by the CEO, that also means you will not have any voting rights at the company that is DeepSeek, which is essentially what you are funding. The investors get the usual VC privileges such as financial information, priorities for future funding rounds, but not voting shares.
So all of this comes down to control. What is it exactly that DeepSeek wants to do with the company? Is this is the vision that they are painting? Is it an unusual sort of vision for the company? Do they have sort of a contentious ambition at all? Or is it just really that they're very protective of their shares? Well, I mean, what's the rationale here? Do you think?
It's certainly not out of protectionism. So we reported many times that DeepSeek CEO Liang is a technology co-idealist. He's a firm believer of open source technology. He believes that, according to our reporting and people who are close to him, he believes that AI should be open source so that it can be made available to all and benefit all. And that vision obviously takes a long time to achieve. And so now that he's raising money, he wants to make sure that the investors are joining him in the long run, and he wants to weed out people who are just here for a quick gain, quick exits, so that he can sort of get the benefits of both worlds. On one hand, he has a fresh war chest to invest in compute, so DeepSeek can continue to innovate with models. On the other hand, DeepSeek's previous success was largely credited for the company never raising any outside money, so that is free from commercial pressure that most startups subject to. And then in this way, he can also make sure that the company can continue to run, hopefully freely of that external commercial pressure.
It is kind of interesting to me that the company's mission is so centered on open source technology, and yet the deal structure seems to be, but by what I'm understanding, one of the most closed deal structures that you say you've seen in so many years covering startups and venture capital. Kind of an interesting dichotomy. Jing, I want to ask you about where DeepSeek's product roadmap is at, and specifically where that roadmap is at in the context of Anthropic coming out with these models that people are scared of being so good. I mean, is DeepSeek still the threat to North American AI models that we once thought it was?
First, I would maybe try to clarify, the sentiment that I gather from talking to AI developers and practitioners in China. They don't necessarily revolve their lives and the real innovation around America. They don't necessarily say we have a goalpost, which is the US or Anthropic or whoever, and we want to outcompete them. Most of them actually are very realistic and pragmatic. They are mostly driven by what they believe is the way that AI should be. That's number one. And then so the threat, I think, narrative is more maybe from the bystanders, for the lack of a better word. And then DeepSeek, as we reported before as well, they took like over more than a year and a half to come up with a next generation model. Um, so then when that model dropped, it kind of underwhelmed a little bit, and then they were also considered for being late to the coding frenzy. They joined that game relatively late. If you see what others have done in China and the US. However, I would not underwrite DeepSeek just yet. Um, uh, I believe that with the way we are living in such an unprecedented era, in so many ways, that as a journalist, that I would just like not write off any possibility at all. So I'm very curious to find out what DeepSeek is going to do next with model updates. And in terms of roadmap, so yes, the company, as we reported, has been taking baby steps in trying to commercialize its technology. whether it's in the way of like having a app. Their app, by the way, has like maintains at a level of like 40 million daily active user basis, which is not huge, but also not insignificant. And then also maybe through like enterprise customer sales, like API access, they are trying that. But then again, that's not their goal. Their goal is not to turn a profit or to increase the revenue at any time soon.
Right.
They want to maintain that sort of idealistic, ethos, if you will.
Right. And look, I mean, by the way, I tend to agree with you. I mean, look, I think we are just one model release away from the entire AI game as we know it flipping on its head. And we saw the first DeepSeek moment, and it seems, inevitable that there will be more wrinkles in the plot with respect to which model is better, which one is more efficient. We know that DeepSeek is open source, which means that people can actually work with it a little more than Anthropic or OpenAI for that matter. And on the show, we have covered the potential of open source models. It is certainly a class of models that people are getting more excited by. And so I think you're exactly right that we cannot write anything off. And by the way, this funding, I mean, now they can go out and hire talent, right? I mean, the talent war is something you touched on in the story.
Yes, I mean they have been losing a lot of key talents. These researchers went and joined most established tech names in China or in the U.S. It's certainly something that has prompted one of the key reasons that prompted them to change the stance on external money. Um, and then we will just see that what they can do to if they can hire more people or maybe even bring back some of the people that have left. And then circling back to this unusual nature of the structure, I think to play the devil's advocate here, if maybe this is like just a necessary evil, like a necessary means to achieve a greater good end. A similar parallel I would draw is OpenAI and Anthropic, especially OpenAI, believing that we want to develop it, we want to get there first before bad actors do. But we also cannot afford to have such powerful technologies be open source and available to everyone. So that's why we have to keep it proprietary, right? Everyone can have an opinion about whether the end justifies the means. Same thing with OpenAI, same thing with Anthropic's unusual deal structure. But then again, uh, anything can be beyond our imagination as things go forward.
Great. Well, Jing, I want to thank you for coming on. I know this is a story that you have reported on very closely. It is great to see that the funding round has finally come to fruition. Jing is our Asia Bureau Chief here at The Information. Thank you for joining us. We will see you very soon. Polymarket and Kalshi are taking extra measures to address fraud that is occurring on its platform. My colleague Michael Rodden wrote an in depth story outlining the current state of those measures. I want to bring him on to talk about what he found. Michael, welcome back to the show. It's great to have you here.
Hey, gosh.
Michael, how much fraud is happening on Polymarket and Kalshi?
Quite a bit, apparently. This is quite interesting because these companies are growing really fast. You can bet on anything from the weather to the war in Iran. And Polymarket and Kalshi have this fierce rivalry. They want to get as many customers in the front door as they can. Obviously, that's great for revenue. They get trading fees. But it also comes with a problem. And that's that they didn't really have the right controls in place to see whether these customers were real or whether they were part of criminal fraud rings trying to test credit cards in order to get, free sign-up deposits or liquidity rewards offered by the programs. And that's a problem because, one, it's expensive. When you have fraudulent charges coming through your systems, you're on the hook to pay those back. So it means that like the revenue that these companies making it, so a fraction of that has to be refunded. So it's a business cost. And then on top of that, it really irks their payment providers. So companies like Checkout.com, their banking providers, they get really sort of antsy about this because the card networks, Visa and MasterCard, they really don't want to have to deal with all this fraud coming through their platforms. So what I found was that Polymarket and Kalshi have been hiring external consultants to come in and help them like bring that cost way down. Earlier this year, it jumped above the rate that normally companies want to stick by, which is about 1 to 1.5% of their total volume being fraud. And so they've been trying to bring that down. But yeah, it's just another challenge that these companies are facing. They've got depositing money, trading instantly with it, but then the funds weren't clearing. That creates a lot of problems as well. Visa would go to checkout.com, which is the payments provider, a startup based in London, which both Polymarket and Kalshi use. And it said, hey, can you like do something about this? Like, it's really expensive. And, if this keeps happening, you get financial penalties. Like, if it becomes really bad, we'll just cut you off. So the companies decided to hire an external fraud monitoring company called Riskified to come in. And basically, what a company like Riskified, it has a long sort of track record of being able to detect how customers interact with the platforms, where certain card numbers might be coming from that might be illegitimate. It basically knows how to monitor for this stuff. And because Polymarket and Kalshi, they're quite young companies in the grand scheme of things, they don't really have this long, detailed history of understanding how customers interact with the platforms. It's like a little deposits here and there normal. Is this big rush of, similar card numbers from one bank? Is that normal for that to be rushing the program and then pulling back out? They just didn't really know. So it's like they've brought in external expertise to try and clamp that down.
Right. And so I just want to make sure I understand the train here. But so Visa tells checkout.com that, well, Kalshi uses checkout.com to check out. Checkout.com uses Visa, and Visa inevitably has to get paid back. So Visa doesn't get paid back. Visa tells checkout.com, we're not getting paid back. Checkout.com says to Kalshi, this is all fraudulent. Is that the train here?
Well, not all fraudulent. It's not just Kalshi, it's Polymarket as well. But generally,
Right. Yeah.
you're
Sorry.
sort of
I
hitting,
use them interchangeably.
Yeah.
I don't. They're
you're
all the
hitting
same to me.
you're hitting onto this problem that like is very common in fintech circles, and it's like Polymarket and Kalshi. They are sort of gambling platforms, but they're also fintech companies, and there's a lot of different counterparties in all of these relationships. You've got a bank, you've got a payments processor, you've got the card networks. You've got the actual platforms themselves. There are other payments processors involved in it. There's this long line of responsibility that connects me, the customer, to Kalshi. So it's like I have to go through all these intermediaries, and there are problems through like the whole chain. And if there's one sort of weak link in that chain, it creates all these problems.
Right.
And so there is this difficulty in all these programs that you need to have the right controls. Otherwise, it causes, one, expensive problems, it's eating into revenue, and two, the risk that you'll just get cut off and you have to, find a new payments processor. Earlier this year, Polymarket lost one of its banking providers, BMO, and so it's had to like find replacements for that. So it's like it's a problem, and there is a lot of fintech companies out there willing to do this, but it's a big challenge to try and, offboard from one payments processor and reboard onto another one. At the same time, you just don't want to irk the payments.
Right. So, okay. So now one of the key points of your story was that Polymarket and Kalshi, they have started to take measures in place to try to address this. Riskified is one of the platforms that you said that they have gone with. I was surprised though to hear from your reporting, you found that they are finding ways to work around Riskified using a platform like AeroPay. Explain that.
Well, it's not exactly working around Riskified, but like I said, there's a million different ways to upload money onto Polymarket and Kalshi. AeroPay is another one of their providers, which is a very complex thing called ACH transfers. So that sort of goes around the card networks and helps you just move money from your bank straight to Polymarket or Kalshi. But on the same side, Polymarket has this big cryptocurrency-based business, which doesn't really interact with these things either. I'm not sure they're so concerned about that because it is a bit of a wild west, and I'm sure they're happy to keep the money flowing on that side. Kalshi also has some sort of tokenized business that helps get around that as well. But for the majority of the users, if you or I want to place a bet on what Elon Musk is tweeting, we're just going to get our debit or credit card, go onto the site, pop it in, and then start gambling straight away. And that's how regular users will approach these companies. So it's important for Polymarket and Kalshi to actually make sure that they're really, keeping a lid on chargebacks, fraudulent charges, disputed transactions, things like that.
Right. Right. Great. Well, Michael, I want to thank you for coming on. That is Michael Broaden, our fintech and finance reporter here at The Information. Last week, Broadcom announced an AI infrastructure partnership with Apollo and Blackstone, anchored by a $35 billion financing commitment. The first project will support 1 gigawatt of compute capacity for Anthropic, with the broader partnership expected to enable more than 20 gigawatts of AI capacity through 2028. But new reporting from The Information shows the deal represents a risky move by Broadcom to boost demand for its chips. My colleagues Dakin Campbell and Valita Pao wrote the story. Dakin joins me now to share what he learned. Dakin, welcome back to the show. It is great to have you here. Walk us through this. What exactly was the agreement that Broadcom agreed to?
Yeah, so this is a $35 billion purchase of chips. Anthropic is going to rent them. Um, and Broadcom, basically, to get this deal done, provided a backstop, a guarantee on some portion of the chips. And so, really, what it means is if at the end of their useful life or at the end of the lease, if the chips are worth less than what everybody thought they might be worth, Broadcom will have to step in and provide some money or otherwise guarantee on those chips. So it is, it's an interesting, it's a backstop, which is what we've been calling it. It basically requires Broadcom to step in if the value of the chips declines faster than everybody expects.
So is this effectively like co-signing a loan, or is it slightly different?
Good question. A little bit, I guess. I wouldn't say I'm thinking about like my student loans. I don't think Broadcom
It's a little more than a
is.
student loan, even though those are quite big.
Yes, right. Thankfully, college didn't cost that much, although it's working on it. Yeah, I mean, Broadcom is basically saying, if Anthropic defaults on its lease and the chips can't be resold for a certain price, that they'll step in. So, yeah, I mean, they're co-signing it to some degree.
Okay. So, you also talked about the transaction involving a special purpose vehicle, SPV, to buy and lease these chips. Can you walk us through how that fits into this equation?
Yeah, so an SPV is basically like a box. It sells debt to get money into the box, and then it basically uses that money to buy the chips. So then the SPV, the box, basically owns the chips, and then Anthropic agrees with the SPV to then lease the chips. So it's a pretty common structure in the financial markets. It's certainly more complicated than if Anthropic were to buy the chips themselves, or if they were to just lease them from some corporate provider. But it is somewhat traditional. We are seeing more use of SPVs in the AI build out. We saw a big one used to build a Meta data center down in Louisiana. And this is yet another example of that.
Okay. And now what about the different tranches of debt? How does that fit into the equation here?
Right. So this has 3 tranches of debt, A1, A2, and B. The first two are the A1 and the A2 are what benefit from Broadcom's backstop. Because of that backstop, they're rated investment grade. The B tranche does not benefit from Broadcom's Backstop, and so they are non-investment grade. So if you're, it's actually pretty interesting. If you're holding the B tranche, you don't have Broadcom standing behind you. And so if Anthropic were to default on their lease, and if the chips were to not be worth what you thought they would be, your credit exposure is actually to Anthropic. And so the couple of people we talked to made the point that, or if you're a bond investor, there aren't many opportunities for you to get exposure to Anthropic, this big high flying AI lab. And so this is one way for you to do that. So it comes in a non-investment grade option, but this way you're getting a healthy interest rate, and you're taking some credit exposure to Anthropic.
How does this deal compare and contrast to the deals that Nvidia has struck?
So it's similar in many ways. I think what is different for Broadcom is not Nvidia. They are not as financially sound as Nvidia. I mean, we just saw this week Nvidia is selling debt for, I think, the first time in 5 years. Broadcom, on the other hand, has $65 billion in debt. They've got less than 20 billion in cash on their balance sheet, and so they are in, I don't want to say precarious, but in relation to Nvidia, they are not in as strong financial shape. So by lending their backstop in this way, they're taking on a little bit of additional, debt-like obligations, and it affects their credit rating a little bit.
Do you expect that we'll see more deals like this to come? Nvidia, Broadcom, other chip companies?
I think so. I mean, I mentioned earlier that we've seen a few SPVs now set up. Um, the people we spoke to in reporting this story think that this is going to be a model going forward. It's the first time this has been done in this size. I think Meta was 30 billion. This is 35 billion. And we've also seen Broadcom talking about, building this platform with Apollo and Blackstone that could see them, um, uh, enable 20 gigawatts of compute. So if you think this was just for 1 gigawatt, we've got another 19 to do. And so I think it's very real possibility that this transaction serves as a model going forward um, that for Broadcom's larger platform. Now it's worth.
And do you think this
Yeah.
ultimately was a good is it a good decision by Broadcom to pursue this approach?
I mean, they will know better than me. I'm.
But we get to assess things on our end too. They did the deal. That doesn't mean it's the right deal, but
Yes. I mean, we do make the point in the story that Broadcom was at risk of being left behind. I mean, Nvidia has done all these different ways of enabling and supporting purchases of its GPUs. This is Broadcom's big sort of entry into that. And so I think if they were unwilling to do that, it would make it harder for them to sell additional chips. And that means that it might make it harder for them to compete against Nvidia. So I think, from what we understand, this was a hard decision internally at Broadcom, but they feel they got to the right uh, solution, and it certainly keeps them in the game for a while longer, and allows them to enable more of these chip purchases.
great. Well, Dakin, I want to thank you for coming on. That is Dakin Campbell, our AI finance reporter here at The Information. As cloud giants like AWS and Google make headway on their own chips, you might think that Nvidia's market share would be coming down slowly. My colleague Phoebe Liu wrote this week in our AI infrastructure column that may not actually be the case. I want to bring her on to share with us more about what she learned and about her estimates. Phoebe, welcome to the show. It's great to have you here.
Thanks so much for having me.
So, you crunched some great data that I want to get into. What was the headline of the data? Let's start there.
Yeah, so the impetus behind this was that there are lots of kind of critics and skeptics saying that NVIDIA might be losing market share in inference because they've historically dominated training with like, I don't know, 90+% of the market, which is kind of crazy. So Jensen Huang, NVIDIA CEO, was kind of defending against this at NVIDIA's last earnings call for the quarter ending at the end of April, basically saying NVIDIA is actually gaining market share inference very, very fast. And basically, we were like, okay, he didn't share specific numbers as to how fast or
Very
kind of,
vague,
yeah,
vague
yeah.
claim.
It was very vague, very confident claim. So it's like, okay, can we figure out whether this is actually true or not? I don't think he would say something false on the earnings call, but I was curious to see what kind of napkin math we could do. And we actually found that he was right, I guess, depending on what definition of fast you have. But we crunched some numbers from talking to sell-side analysts and customers that run AI workloads. And basically found that NVIDIA's market share in inference has grown from around 66% to 74% over the past year, which is, I guess, a pretty marked improvement. And this is significant because as a whole, AI workloads are moving from training to inference. I think our back of the napkin or back of the envelope math found that about 60% of AI workloads are from inference, so revenue generated from running AI rather than training it. And that's up pretty significantly from, I think, using Deloitte's numbers, 50% in 2025 and around a third in 2023. And that's, I think, set to grow to as much as 80% over the next 2 to 3 years. As Jensen said at the Computex conference in Taiwan earlier this month, inference is money. So having market share of inference would kind of determine who owns the next era of the AI boom.
So there's a lot to unpack there. So the first thing I want to get into is the definition of the data that you focused on. You were focused on inference data here. So talk to me about what is included in these workloads and then what is excluded, because NVIDIA chips can do a lot.
Yeah, for sure. And the first thing to note there is that we're kind of looking at a proportion of hardware sales that go to running AI workloads, so inference rather than training. The interesting thing is that NVIDIA GPUs do both, like the same GPU can run both training and inference workloads depending on what a customer needs it for at any given time. And the way people kind of estimate that, I talked to CoreWeave about this, and they kind of look at power usage patterns to determine whether a customer is using a given GPU for training or inference at a certain time of the day, for example. So that's kind of, we were looking at the time used for training or inference for NVIDIA to kind of break out proportionally how much of the GPU sale went to training or inference. For other customers, generally speaking, their total AI inference revenue is much larger compared to NVIDIA's. So we ended up taking, I think, 80% of Broadcom's XPU, so their alternative
Right.
to NVIDIA GPUs, 80% of Broadcom's XPU sales, which analysts were saying are about 60% of Broadcom's semiconductor revenue, which is reported in its annual and quarterly financial reports, and then pretty much 100% of the data center revenue from AMD, Marvell, and then hardware sales from inference-specific younger players like Cerebras and others.
So, I mean, why is it that is it all the Grok acquisition that is paying off here for NVIDIA? Is it lackluster marketing from the competing firms that you mentioned? What is the root cause here of NVIDIA's share remaining so competitive and growing increasingly competitive?
Yeah, for sure. So it seems like within NVIDIA's data center revenue, it's still overwhelmingly GPUs. I don't think we've seen widespread adoption of the NVIDIA Grok integration, the LPX rack, just yet. I think they're set to ramp up in the next couple of quarters. So it's still largely GPU right now, even though NVIDIA did spend a lot of money, like $20 billion in cash to license Grok's technology. So it's just looking at the share of NVIDIA's data center revenue that is coming from inference versus training, just because more people are using AI rather than training it. And basically, because Nvidia is the biggest player, as long as their share of data center revenue that comes from Inference is growing, and that overall Nvidia is growing at similar rates to other players, which analysts said is approximately true right now. Nvidia's market share in Inference will grow, even though other players are also growing alongside it. It's a pie that's growing really fast. I think the total inference market share pretty much doubled the total AI inference market size pretty much doubled over the last year. So it's kind of everyone kind of has room to grow here, but because Nvidia is the biggest, it's kind of easy for them to grow more than everyone else, if that makes sense.
Right. And so second to Nvidia, I mean, who are the players closest on its tail in terms of growing market share that we should be paying attention to?
Yeah, so I guess this is a little bit of a different angle on what Dakin was saying from his excellent reporting. I think it's pretty well understood that the second player is Broadcom, because they make custom, they call it XPUs for Google, Meta, Microsoft, and soon to be OpenAI. So those are kind of the biggest players who are using alternatives to NVIDIA's GPUs. After that, it's AMD, then Marvell, which makes AWS's Trainium chips, which are also kind of gaining market share right now. And then other kind of younger kind of startups, but some of them are public, like Cerebras, Tenstor, and D-Matrix. Grok would have been in this category before it became part of, before its inference chip technology became part of NVIDIA. And that category is probably around 1 billion total, like a pretty small share of the market, but maybe growing.
Great. Well, Phoebe, I want to thank you for coming on. That is Phoebe Liu, our Nvidia reporter here at The Information. Fox said it is buying Roku for $22 billion in a mix of cash and stock. It is the latest data point in a broader story of media consolidation. For more analysis, I want to bring on Mark Douglas, president and CEO of Mountain, an advertising software company that powers TV networks like Roku and Paramount Plus and NBC. Mark, welcome to the show. It's great to have you here.
Thank you.
So what do you think? Is this a good deal for Roku shareholders?
I think it's a great deal for Roku shareholders. Their growth rate has been really strong lately, so I think some of those shareholders are like, "Why not go for more growth?" But in the media business, scale means everything, and combining these two companies makes them the third largest streamer. And I think that's really it's needed, and it's something I think ultimately both companies' shareholders will appreciate.
So that was easy question, Roku shareholder. What about the Fox shareholders? That was just a layup for what I really wanted to know.
Well, so I think the way this is being viewed is if you look at it completely independently, Roku has 100 million users. Fox has 100 million users. And the deal is not legally a merger, but it's somewhat effectively a merger. So, but Fox has more than 100 million users. So what's the value of that? And I think this deal somewhat says the value of that is nothing. And so if you're a Fox shareholder, you're not going to be too happy with that. But the reality is the world continues to move towards streaming, and the streaming assets are where most of the value is, and that's reflected in the structure and price of this deal.
How does this affect your business? You work with Roku, right?
Right. Well, I think we do. We have partnerships with both Roku, Fox, and nearly every other streaming company in America. And for us, we continue to work in a similar manner. Those deals remain unchanged. The scale of consumers watching TV on streaming continues to grow. And so as these companies merge, we'll likely continue to work with each of these now divisions of one company independently, but collectively the same. So we see it as great for the industry. We see it as great for streaming. Our mission is to make every size company have access to television, which is the largest entertainment medium in the world for advertising. And so it's great for us too. It's great for Mountain also.
And I'm just trying to think, here from a product perspective, Roku, I mean, they obviously they make the TVs, they have the platform, they have been moving deeper into the average. We've written about the turnaround that Roku has had.
Yeah.
My co-executive editor Martin Pierce had a great column about that turnaround last night. I'm just trying to think how you think Fox might change the product, if at all? How you think the product might change? Where sports fits into the equation? Like, how do you think about that?
I wonder if Roku, 2 years from now, is still a television manufacturer. I think they do a lot of things, and that may not be something that Fox themselves continue to want to do. But outside of that, I think both companies, now having the third slot and having, pretty decent share of overall streaming hours and advertising spend. I think it's the streaming itself, the advertising is where all the money is. Whether they should continue to be a TV manufacturer or not, I tend to think not. But we'll see how that shakes out over the next, 12 to 24 months.
You've got a pretty good ground view of the advertising market at large.
Yeah.
What is the story right now in advertising?
I think basically it's the fastest growing channel overall, especially for the SMB market, small and mid-sized businesses. I think one thing that people commonly forget is television is the largest entertainment medium in the world. 5.1 billion people a day watch TV on average for 3 hours versus about 4.1 billion use social media for an average an hour. So it's this massive medium that most companies have been cut off from because just the expense of getting on television, expense the ads, and AI and tech companies like us, Mountain, have been democratizing the medium, and I think it continues to get more important in the advertiser's mind. Even while we speak, World Cup is being streamed worldwide. It's the biggest thing happening essentially in sports and entertainment right now, and it's just such an important part of how people kind of get entertained, and continues to grow in that regard.
I'm sure they're going to be talking about this deal next week at Cannes Lion.
Yeah.
What do you think are going to be the big questions outside of TV, inside of TV? What are the big topics that are going to be discussed there?
Well, I think what's the interesting topic going to be is whether I have a feeling Roku is going to position it almost like they acquired Fox, and Fox is going to position it like they are acquiring Roku, because both, like we talked about earlier, both companies in terms of users are equal size, and the users that are on their streaming platforms, in the case of Fox, are the most important. Obviously, Roku is all streaming. The other conversation is it's a continued step in a major media company consolidation. I think the way anyone should look at kind of consolidation of these companies is if you name a network and you don't have a clear reason in your mind why you would go there and watch television, you have to wonder whether they're going to be independent in the future. So for someone like ESPN, it's easy, sports, right? For Disney, it's children's entertainment. But there are networks out there that you're hard pressed to say, well, why would I go there and watch it? And those are the ones that I think are going to be hard pressed to remain independent over the next year or two. And so there's more to come, I think, in terms of consolidation in this industry.
And going back to this, the user calculation here, so similar size profiles in terms of user bases.
Yeah.
I mean, I haven't looked too closely at the financials, but are both user bases equally as valuable, or is one company's user base, is it worth more?
Well, I think when you think of streaming, Roku is one of the companies that essentially pioneered the concept along with like Netflix. So I think just in terms of at least perception, Roku has the advantage there. In terms of ad dollars, I mean, how you monetize those users, that's ultimately where the rubber meets the road, so to say. Offhand, I don't know the answer to that specific question, but I think it's easy to analyze those numbers. But I think overall, the Roku brand in this context is perceived as more valuable than the Fox brand. It personifies streaming for the industry, and I think their customers are going to be very happy to see them gaining even more scale through this acquisition.
Well, hopefully their shareholders see that as well, because as of now, they weren't too happy about it, but
Exactly.
it's a long road. So, Mark, I want to thank you for coming on. That is Mark Douglas, President and CEO of Mountain here on TI TV. That does it for today's show. A reminder, we are on this stream Monday through Friday at 10 a.m. Pacific, 1 p.m. Eastern. If you can't make it then, episodes are available on theinformation.com, on our YouTube channel, or wherever you get your podcasts. Make sure to follow us on social media, on X, on LinkedIn, and on TikTok. I'm already excited for our next show tomorrow. Have a great rest of your Tuesday. Bye-bye for now.